Hello, hello. Thank you for joining me on a beautiful Friday, 17th of March. We're going to get into a bit of an economic wrap. If you're watching me on the line, guess what? Yes, I am wearing a denim jacket. Hey, denim isn't out. I don't care what they told you. Today, we're going through pretty much what's been happening around the world is this Credit Suisse, one of the world's largest banks and the Switzerland's second largest big bank, dropping up to 30% within a day of trading and what caused that. So I'll take you through the main reasons around that and whether or not we do have an inherent risk in banking systems around the world. Then I'm going to give you a bit of an economic update that was received from Westpac's chief economist, and basically take you through what Bill Evans is saying about the current state of economic markets all around, mainly around Australia, but all around the world. So I'll give you a few key points there. If you want to listen to the full episode, please head on over to the podcast or Spotify or YouTube channel. And if you stay on the line, guess what? This is just general information. Please don't consider it as personal advice. If you do want any personal advice, please go and see your licensed financial planner. And if you want some financial advice, hey, reach on out to hello@angeladvisory.com.au. We'll see what we can do. Anyway, let's get into it because some pretty big news going on around the world. Basically, what happened with Credit Suisse? Credit Suisse had a really big share price dump in trading. So it went down as low as 30% before ending up about 20% down. Look, I'll be honest with you. I'm recording this on the Thursday night. It's not Friday morning, so I don't know what happened in overnight trading. But let me give you a bit of background as to what's going on. So look, this bank is a pretty big one. It was founded in 1856. It's now one of the biggest in the world. And it's one of probably the 30 largest banks around the world, measuring up alongside names like JP Morgan Chase, Bank of America, Bank of China. So it is massive. But basically what happened is Credit Suisse came out and said, we want to raise more money. We want to do some restructuring. Shareholders, can you please give us some money back? And one of Credit Suisse's largest shareholders is the Saudi National Bank. And they basically said, no, we're not going to give you any more money. Now that sounds pretty bad, but essentially one of the main reasons that the CEO there said they didn't do it is because they currently own 9.8%. If they own more than 10%, they enter a whole new world of regulations, both with their current regulator and with the European regulator. And they just said, we don't want to go into a new regulatory regime. We're happy with where we are. We don't want to have to provide extra insights and information. Let's just sit where we are. So they still believe it's an amazing bank. It's really strong. But one, they don't need the money. Two, they don't want to go into that new regulatory regime. So what does that mean is that coupled up with this, so they're probably one of their largest investors saying, we're not giving you more money. Plus the company had $7.9 billion in losses in 2022. So a massive loss. But also customers withdrew about $133 billion throughout 2022 from their bank. Now, if you couple that up with what happened to Silicon Valley Bank, and people pulling out money, it just means that people got worried. So they said companies are pulling out money. They don't have enough cash to meet their losses. What's going to happen to the bank? They're going to have to keep raising money. They might need more. The bank said, we're pretty comfortable with where we are. We're going to get rid of 9,000 people, so 9,000 jobs. It's not a good thing, but it's good from a bottom line perspective because that's what needs to happen for a company to start making more profit. And you know what? When you actually get rid of people and you restructure, you need to pay these people out. Therefore, you need cash. So if you've got people that have worked in the business for 20, 30 years and you actually need to get rid of them, you need to pay redundancy packages like you would see here in Australia. So they need to fund the restructure. That's part of the reason they needed the money. And all of a sudden, the Swiss National Bank came out and said, hey, guess what? We will give you money. And shortly after the Swiss National Bank said, we'll give you 50 billion Swiss francs or 53 billion US dollars, they said, yep, great, we'll take it. So restores a bit of confidence in the bank, and the Swiss National Bank know they'll pay them back. So there's no real worries there. Unfortunately, it's not just a Swiss problem. So the entire financial sector around the world is feeling the pain a little bit on the back of what happened in the US with some of those smaller banks. So you got financial markets down all over the world because banks are such big players. And a lot of these banks all around the world, or banking stocks or banking indexes, have all been down. Just because there's just no confidence in that sector or economy. Now, let me take you through something fun and let's look at some economic outlooks, what's happening around the world, and what does Bill Evans, who is the Westpac chief economist, what does he think is happening around the world? So he expects our RBA cash rate to go up to 4.1% from 3.6% where it is today and stay there until at least December 2023. But in December 2024, he expects interest rates to be down at 3.1%. That's at RBA cash rate. He thinks the US will keep raising rates until June 2023, same as us, and then they'll stop. But by December 2024, they'll drop off a whole 2%. So he's thinking our rates will only come down 1%, but the US down 2%. Now think about it. They are currently at 4.6%, and therefore they'll still have higher interest rates than us. Now, what does that mean for the Australian dollar? He expects our Australian dollar is going to get stronger against the USD. So currently at 0.67 cents against the 1 USD. He expects it by December 2023 to be 0.74, and then by December 2024 to be 0.77. Now, what's going to lead to this? He says commodity prices will keep us strong. China reopening will have a demand for Australian dollar. But with the decline in, or the sharp decline in the Fed funds rate, so the US Federal Reserve rate, that will draw more people to Australia because of our strength and because of our expected cash rate will stay higher. So that'll be some of the leading factors contributing to the Australian dollar getting stronger against the US dollar. So if you are investing overseas and you are in an unhedged allocation, just keep that in mind. Some of the other things he mentioned is that he does expect our gross domestic product, or our GDP, to go down. Unemployment rate, he expects to go from 3.5 where it is to now to 5.1% in 2024, but inflation to come down from 7.8% all the way down to around about 3% in 2024, but still remain a bit higher at 4%. Wages growth he expects to stay up, but dwelling prices he expects still for 2023 to be down another 8% on top of the 7% it was down in 2022, so a total decline of about 15%. So there's a whole lot of factors they look into to get to this point, which I'm not going to bore you on. But some of the other factors, as I keep looking through this slide deck, is that US inflation has gone okay, rent growth clearly in downtrend. So the 6-month annualized rental growth has started to kick right up. So obviously lack of housing supply, people needing rentals, nothing's there. Rent prices are increasing. Now our wages are not increasing by as much as the US. So the wages in the US are increasing by a higher percentage in Australia, which, it's interesting in itself. But let's look at migration. So we normally take on about 250,000 new migrants each year. In 2020 and 2021, we basically didn't take on anyone. So what he's expecting is in 2022, we've taken on 400,000 new net overseas migration. So net people have moved to Australia. And this year will be another 350,000 people coming to the country. Now, you could imagine that will lead to more population growth. That will lead to more people having jobs, which probably a higher unemployment rate. And probably, to be honest, more stress on our rental prices. So some things that some clear indications and economic indicators that he put towards or how they estimate where house prices are and where they're going is residential construction approvals are down compared to historical averages. The housing finance rates, so the new lending, new finances is lower at the moment than it was during the GFC. So people are not buying and not financing properties. And that leads to, obviously, it just means that people aren't buying, which we all know now. Household incomes, while they've gone up slightly, people are spending more money, which is a bit unfortunate, but that is what we expect when inflation is going as high as it currently is. But obviously, one of the big things and one of the big focuses for him was just indicating that the Australian dwelling prices have slowed down dramatically. So they've gone from, we'll call it Feb 2022, from a massive high, it's dropped about 10% based on his charts just there. Moving over to what's really interesting was housing buyer sentiment versus price expectations. So people are actually thinking that prices will start to rebound now based on their most recent research. However, people do not think it is time to buy a dwelling, because if they see prices going up, inflation is still high, interest rates still high, they don't think it's a good time to buy a property. So just goes to show what is happening in that space. For dwelling price forecasts, he expects throughout 2023, the entire country will be down. So even Brisbane and Perth, which ended up for 2022, he expects they'll be -6, -4 for a total drop of -8 throughout 2023. Biggest drop being in Melbourne for the year 2023, and Sydney following that at -8% for 2023. In terms of just comparing commodity prices to the Australian dollar, Now, over the history, if you've seen commodity prices go high, you normally see the Australian dollar go high as well. But ever since maybe 2021, commodity prices have been quite elevated, but the Australian dollar didn't quite kick up against the US dollar as it normally would. So he's expecting a bit of a convergence where the commodity prices will come back down and the price of our Australian dollar will increase. And just quite interesting on that front. So, watching these things are really great because it helps us shape our portfolios, and so should everyone else. Knowing what's happening with immigration, house prices, and even just the general Australian economy will help us sort of dictate what we do with money and how much confidence we've got going forward. So hopefully you enjoyed this little episode with us to get an insight into the things we think about, the things we watch. If you've got any questions, reach out to us. But thanks for listening. Have a great weekend. See you soon. Bye.